My long-term care policy is increasing its premiums. What are my options and how do I evaluate them?
Yeah, so it's kind of interesting. So long-term care, I remember, 20 years ago, quite inexpensive. Lots of people out trying to sell it, and wholesalers knocking on the door all
Hmm.
the time. We specialize in retirement, so hey, we got this great policy, and this is how it works, and then all of a sudden, all those people bought policies
Yep.
and got to an age where they're starting to use them, and we are seeing from clients, asking us for their help on an analysis basis. uh, what do we do? Because now they're talking about raising our fees dramatically, and or cutting our benefits and what have you. I think it's really kind of sad. It's basically the insurance companies were gathering money and not paying it out for a long time, and now they have to pay it out, and they're starting to go sideways on it.
Basically, the insurance or a lot of these companies undercharged for
Yeah.
what, so they expected a lot of people to drop these policies over time, or and just not live as long and not as need as
And
much long-term care.
yeah, they missed it on the actuarial basis, essentially. I mean, because that's
Yeah.
how they look at it, right? And they've done that before. I remember they had these riders on the annuities, this lifetime income riders, and there was a guaranteed pool that was growing at 7%, and there was some good-looking deals. And 2008 happened, and they all abandoned those things. They kept the old ones, but they wouldn't do any new ones,
Yeah.
and and to me, that means the consumer was winning. The insurance company got it wrong. So that's probably exactly what happened here, is that the consumer was winning and the long-term care policies being inexpensive, and they just missed. Long-term care insurance has gotten to be long-term care itself, expenses have gotten to be pretty incredible. I've heard some unbelievable numbers from some clients, that are either have spouses in care or have friends with spouses in care, or friends in care, and it's incredibly expensive.
Yeah, and so usually, what are your options? So in California, they essentially have, you can keep your current policy and just pay the increased premiums. That's one option. Your second option is to negotiate with them. California requires that any policy to be able to lower your benefits for a lower premium. And then the third option, or there's a couple other options, but a third option is to ask for a paid up option. Essentially, they take whatever premiums you paid and then pay that out as your long term care. And
They
then
usually give you a little factor there too, right? So if you put in 50,000, you might get 75,000 worth of coverage, say like
it
1.2
depends
or
on when
something.
they're doing the settlement,
Yeah.
um, or when they're providing these options. So it's usually at least 1x your premium. So at least you'll always get your premiums back. And then your final option is always to walk away. But at worst you would always take that paid up option.
Yeah, so a paid up option means you don't pay anymore,
Yep.
right? And so they're done, and you get your money back and maybe a little bit more depending on what factor they use. So yeah, you wouldn't want to walk away, versus that. At least you got something there. But if they're, so that's the tier. Keep it, pay more. Yeah,
Yep.
maybe pay the same or a little more, and have less benefit.
Yep.
Yeah, or do the paid up option. Those are the big ones. There's other things that come into play, and what have you too. But that's the analysis. And so, I mean, what are some of the things that we would want to look at to analyze that?
So long-term care policies are, these are policies that don't return premiums once you, so if you pass away, the policy's gone. So it's kind of like a probability game. So does your family have any history of needing long-term care? So if you have someone that, if dementia runs on your father's side of the family, I'm going to say you should think about keeping this policy even if it's just a reduced benefit.
Yeah, exactly. It's, we have clients using long-term care insurance policies, and they're really, really happy that they have them. So, again, it depends on a lot of things. I guess one of the things I'd throw in there as part of the analysis, besides the medical side, is just, their overall financial situation. So what if we run their plan, run it through a long-term care scenario without a policy?
Yeah.
What happens? So if they're in the high 90s on probability of success and it drops back to 60s, oof, man, you might need to pay even if it costs more, versus somebody who has very little change in their probability of success. So because they essentially have some self-insurance
Mhm.
with enough money in place, then maybe they could take the paid up option or at least the reduced benefit option and try to keep their outflow the same. So I do think that you'd want to run that through a plan and take a look at it and see what type of impact would this have on me or me and my spouse.
Yeah, and the
Or
next thing is
significant
to
other.
think about what is the paid up option or the reduced option.
Yeah.
So let's say I am 85. I have the option that my premiums are going to double. I can't afford doubling my premiums. What can I give up? Maybe I have an inflation policy on my long-term care benefits, and so I don't. Maybe I'm at a point in my life where I don't need that inflation policy anymore, and so I can give that up while still maintaining that lifetime benefit.
Yeah, because a lot of times you'll see a policy with like a 5% increase. So the benefit that you have might start off at a certain level, but then it grows 5% every single year. So if I'm 55 taking that policy, that's a big deal. Because if I'm going to
Yeah.
get the same exact amount when I'm 85 and need it, it's not going to be much money, right?
Yeah.
So that rider is really important. But now that I am 85, it's not as important,
Yeah,
right?
because if I'm using it in 5 years,
right.
5% inflation,
Right.
it's
It
you can
adds
manage
up.
it. You can manage it.
Yeah, it'd be nice to have, but if it means paying double or triple or whatever it might be, maybe it's not worth it. So it's kind of different based on where you're at, and this is unfortunate that we're even having to go through this. There's no institutional situation here that can take care of you if you have any money. We do have Medi-Cal here and Medicaid for the rest of the country that will pay for your long-term care, but it's so restrictive in terms of what money you can have.
Yeah, essentially you have to have nothing left, or
More or
basically
less, yeah.
nothing.
But it'll feel like it, that's for sure. Yeah, and a risk damaging your significant other too. So that's where the policies are important. And so this is an issue that just keeps coming up. People send us the letter, and then we do the analysis and give them some feedback on some of the options. Even doing some conference calls with some of these companies to try to get more feedback on a live basis on what some of the options are. And you can extend oftentimes the period to decide if you just ask, because sometimes it takes a little while to really analyze it and figure out what you're going to do. It's an important decision, both from a cash flow standpoint and the possible coverage standpoint, that you might need in the future. So it's a good question.